those of you who are just getting started with your 14-day free trial, or maybe you just started a subscription, I do encourage you to take advantage of these 4 steps. Right? You can download the free Quick Start Guide to see how to use some of the tools and get started, for example. We have some flash tutorials that will walk you through using some of the specific tools, the search tool, search by symbol, option chain, and portfolio. We do host a variety of webinars during the week. Of course, I'll show you where you can access all of our archives, which is, we always end up doing, referencing the webinar archive 1 or 2 at a time. And of course, those of you that are just getting started, make sure you sign up for a free coaching session. That's a free 35, 45-minute phone conversation with myself or Ernie. Will walk you through the tools on the site and answer any questions that you have as well. Okay? All right. So our first question comes in from, I'm sorry, is it Brandon? Okay, it's Brandon. Brandon's question is, are there any stats on which is more profitable among the weekly suggestions you have on selling versus calls versus putting on bull put credit spreads, for example? Okay, here's what I can tell you about that, Brandon. I don't have the numbers with me right now, but I can get them. I'll find them from Ernie, but I think I have a general idea. We're going to actually look at some of the historical tools to illustrate your question, okay? And at the same time, we're going to look at our defaults as well. On PowerOptions, of course, we support over 23 of the most commonly used option strategies. You see up at my top, I've got covered calls, bull put credit spreads, married puts, bull call debit, and more. Straddles, strangles, iron condors, iron butterflies, these are all strategies we support, so we're a one-stop shop for any options investor. Okay? Brandon's question is related directly to what is more profitable and more successful, weekly covered calls. Okay, I might actually change my account here, but anyway, in any case, selling weekly covered calls on a position or bull put credit spreads. Okay, now we're going to do 2 things. The first thing I'm going to show you is in our covered call menu, we do have a structure that's set up called weekly picks of the day. And this will show us the top 2 or 3 trades that match this criteria that Ernie created. Now we're showing you on this page what is being used for the criteria. So we need an income of at least 20 cents. Excuse me. Expiration, of course, was less than 8 days, so next week's expiration. Stock has to be in an uptrend. We want a MACD crossover to show a positive value. And we've got some open interest for liquidity, no earnings announcement, and at least 1% in the money for protection in case the stock falls a little bit. Okay? And it says the high return will generally mean high risk. For biotech and high selections, consider going more out of the money for better protection. Well, where I'm going with this, Brandon, is that what Ernie did is he went back about a year ago, and this has been up for about 8 or 9 months, I think, but he went back and started back testing various criteria that he would commonly use for a covered call, both monthly and weekly. What kind of stocks you'd look for, what kind of trends, things that made sense to us that were part of our default searches that we would look for if we were opening a covered call or naked put. And Ernie started running these iterations using the historical tools. He went through many iterations, and what you're seeing here is the result of what he found. So I click that link on the right there that says see how we develop these results, and this is a breakdown of the time frame of what Ernie tested, what he found worked and didn't work, some things in the process of his back testing that surprised him as far as management or even looking for positions with higher volume, avoiding earnings and things of that nature, what worked, what didn't. And so what he found out at the end with the criteria that's posted, Brandon, over the time from May 15th, 2015 to May 21st, 2016 was there was 80% of the trades were winners. The average return was 1.8%. 20% of the trades had a loss, right? And 80-20 is what it came out to be, but the average loss was 3.2%. Okay, 29% of the losers were a result of hitting a 10% stop loss, which he was using on the covered call position. The average loss on the stop was 6.7%. So in any case, the main goal here is starting with $100,000 over that time period where there were actually, you can see here, let me scroll back up, where there were two significant dips in the broad market. This is the S&P 500. There were two significant dips in the S&P 500, and then of course two naturally high rises to get back, but essentially you can see it was pretty much flat over the time with the two big drops downs during that time period. But again, what he found was he structured all this in, ran the backtesting model, started with $100,000 with the stop orders in place, or just taking assignment if it was right, and at the end of the 1 year period, the account was at $142,000. It was a 42% gain for this weekly covered call screen in this type of market where you had dips, you had big losses here that hit the 10% stop order, and you had large upswings as well, two of them, but generally the market was flat. Okay, so that's one expectation for weekly covered calls that I can point you to directly. Now, I don't have the bull put credit spread back testing on ours done over the course of that year. I'll have Ernie do that to see what they compare. But let's do something else very quick. Let's go to covered call and let's go to search. The weekly picks of the day is designed to be a quick format. It's usually run once a day at around 11 a.m. so you can see the top 3 results. But if I go into the search screen, okay, I can go ahead and select weekly picks of the day, and this is going to give me the full list. Now, we're not going to do a lot of back testing here because we have a lot of other questions that have come in, Brandon, but here's what I'm going to do. Let's go to the backtest tools and PowerOptions, okay? And we're going to go into the Smart History Excel. Today is, of course, the 23rd. So I'm going to run one search on the 9th for our weekly covered calls, and then one at the 16th. We're just going to look at the numbers. Okay, so let's go to June 9th. That would have been the Friday. I'll select June 12th, the Monday following June 9th expiration. And let's pick our weekly picks of the day. Okay, so let's submit that back test and see what we've got. So on June 12th, the positions, now this is going to be a little bit slow. I do apologize for that. The reason why it's slow when we're doing these Friday webinars and we access the back testing is that right now we're actually uploading today's closed data into the system. Our historical data does go back to April of 2006, okay? So it's just showing me the top 15 results for these positions, and none of them had earnings, of course, between now and expiration or ex-dividend dates. Well, what I'm going to do here on our back testing, now that I have the results, the top 15 that match this search, I'm just going to hit Calculate Group Results. Let's say we entered even money, Brandon, into each of these positions, and that's something I'm going to have to talk about in a moment here. This doesn't look too good, all right? So there's about, we see here over on the right, the wins and losses for the top 15 that were found on Monday morning. I'm sorry, it would have been the close. I should go back and use the 9th. Well, we'll use this for now. Say that I opened it on Monday, but really I should have used Friday's close prices for Monday's open. But this is Monday's closed going to Friday. And we do have, do I have any? Okay, good. No, I don't. I don't have any duplicates, it looks like. Good. So only 7 out of 15 were successful, 47%. And the average return from the week of June 12th to June 16th is minus 2.2%. I have a high feeling that some of those, I apologize, folks, some of the drops that occurred there with the tech industry over that time. You see Sina was in here. BABA took a loss as well. And the first one there, Cenex, well, not really one that I consider tech, but see some other techs in there that were a result of the pullback. Clovis, of course, hit its maximum return and as well. Okay, so what am I looking at here? I'm looking at something that the SPX was flat. We lost 2.2%. Not great, okay? But let's take a look now. Let's go back to our historical search and let's run another one. And instead of that, we're going to say after June 19th, I'm sorry, 16th, my apologies. So to June 16th, let's run it Monday the 19th at the close, weekly picks of the day. So on June 19th to today, as we load that up, oh, I apologize. All right, here's our top 15 of 22. Some of the same stocks appeared. Baba is still in there. I believe we saw US Steel in the last one. Is Micron Technology also in this? No, it's not. Apache's in there, which is very interesting. All right, any case, as before, let's calculate our group results. So the first week, 7 out of 15 or 47% success rate on the covered calls for a minus 2.2 loss, assuming even money. This looks about the same. 8 out of 15, okay, or a loss of 0.6. Okay, so this wasn't too great, but I know for a fact that these weekly covered calls and naked puts, especially, I had a customer I talked to last week, weekly naked puts, he'd been up 30% since November with the weekly naked put screen. And I think the weekly covered calls have been doing well too. It's just that with management involved, these are just showing us we didn't take any big losses other than a 3.6% one, a 5.4 on Apache, of course. That's why I said it was interesting it was in there. All right, so where am I going with this? Well, let's do the same thing. Now, one thing I can tell you that we found, let's go to bull put credit. And let's go to our search. When Ernie backtested the bull put credit weekly spreads, he found something interesting. What he found, and you'll notice here on our default searches for our bull put credit spreads, we're looking at all expiration dates, but we're forcing it to be 8 to 17 days out in time. Well, that's not weekly, is it? That's 2 weeks out. Why don't I use the 7-day out? What we actually found with this backtesting is that going 2 weeks out, you get a better net credit, so when you do hit a loss, it's less of an effect. Trying to find a good probability of 70, 75, or 80% with 5-day out or 4-day out bull put credit spreads, you might only be getting 10 cents, 12 cents, maybe 15 if you're lucky, on a 1-point or even a 2-point spread. But even if you got 15 cents and you took the full loss on that position and it was a 1-point spread, you still wiped out about 9 previous trades. By going 14 days out in time, the premium generated was actually closer to 30 or 40 cents. And we can see that up here. 1 second. So we've got even a credit of 115, but that's on a 2.5-point spread. 28 cents here on a 2-point spread. Here's some 17s, but they're on a 1.5 spread, and so on. So one loss only wiped out 3 or 4 previous trades. So it didn't have as big as an effect on the portfolio. And in his backtesting, using the criteria that he found worked best with the technicals that he was using, again, with MACD and simple moving averages, plus standard structure of these, is that the return, if you went 14 days out in time instead of 7, was actually higher, which is not what we'd expect, right? Because we're told that if we, of course, go week by week by week, we'll get a better annualized return. But that's assuming 100% winners, which no one's been able to find. And as we already saw, I'm not trying to state that that weekly covered call search or even this weekly bull put search will have a 100% success rate. What I'm saying is that we back-tested these, and the reason why this criteria is here is because we found these after various iterations, looking for things with dividends or not dividends, in the money versus out of the money, 80% probability versus 70% probability, avoiding earnings versus not avoiding earnings, using Bollinger Bands or simple moving average or not using simple moving average. We ran those tests, and we settled on the one that gave the best performance. Again, this was also around 40% for the year that was tested. Okay? But every market's different, and I'm really just doing an illustration of that without further data to supply to you. But let's do the same thing we just did. Let's go to backtest. For bull puts, let's go to Smart History. Let's go to June 12th, right? Our first series, where we had a 47% success rate with covered calls and a minus 2.2% return. Let's see how we would have fared with the weekly bull puts. You might have, and I'm doing this very broad, I'm not doing further research and analysis to choose the top 2 or the top 3, which Ernie does with the weekly picks of the day. All right, so here's our top 15. Not surprising, we're seeing similar stocks because we're using similar criteria. Micron, US Steel, NVIDIA. BABA's not in here. BABA is not in here as it was in our first result. But again, as we did before, let's calculate the group results. Okay. All right, so June 12th, I apologize again, but this would have taken us to today, remember, because we're using 14-day out positions. On the covered calls, the first week, June 12th to June 16th, was a loss of 2.2%. Then we ran the second weekly covered call from June 19th to today, and it was a loss of 0.6%. Of course, we would manage those that were losing and so forth. Now we're saying if we use that 2-week out bull put spread that we ran on June 12th, and we take the top 15 results as it plugs and chugs and it tries to go through as we're uploading the data. I apologize for this one as well. That's what happens here. While I'm doing this, okay, hold on one second. We'll just get a look here to give you a better idea, Brandon, as well. While we're waiting, Sam says, hi, Mike, and good evening to all in the room. So hi, Sam, and we're just waiting to see some results coming in here as well. All right, Martin, I see your question. Okay. All right. I apologize. It's really plugging and chugging here on the back testing for the bull puts because we're loading in the data right now. Let's go back here. I'll go back here. I'll let you know. I'll see that as soon as that comes up. Come on. Usually it's much faster than this. I know we're learning a lot of data, but while we're waiting for this, I'm going to answer a question real quick that came in from Martin. Okay. Martin says, when would you put the trade on for the ones that you sent out today? For example, should the U.S. Steel put already been entered today, or would it be done on Monday? If so, when? Okay, now let me go back real quick while I'm waiting for these results. They will come in, or we'll get a timeout error, and then I'll correct it. I think what Martin's asking is related to the naked put weekly picks of the day. And earlier today, or just in the straight search for the puts, if I went into the search there and did the weekly picks of the day, do I see X? Okay, here's X. Okay. Now, Martin, what I want you to pay attention to, what I showed earlier in this, is on the picks of the day, even though RH, the top one, showed up because it was run again at about 11 o'clock this morning, but you could see the full list at any time. When you click that link for see how we develop these results, Ernie walks through what these results were based on. What these results were based on is opening the position at Monday at 3 p.m. Okay, before the market closed, seeing which trades match then. Okay, you know, orders need to be put in before the close between 3 to 4 p.m. That's how the testing was done on the weekly naked put, which did about the same. It went up from $100,000 to $147,000, so 47% return, as opposed to the weekly covered calls, which were at 42 during that 1-year time frame he tested. And there were 106 trades over the 53-week period. But that's what he's looking for. He was opening them on Monday. These results do not include trying to have a position open over the weekend and what might have happened with any unexpected events as well. Okay? All right. And that's what we're looking for there. Now, let me check my window. Yay, here we go. Dear God. Okay, well, clearly we have a winner here. Whether it was market conditions, whether it was the fact that, remember, on that weekly covered call, one of the things that you know, when you're doing 7 days out, as I mentioned, you could only go about 1% out of the money to get a reasonable premium to still have a reasonable return. We saw some stocks that maybe fell 1.5% or 2%, you took small losses. This bull put search for that 2-week period, June 12th to today, the 23rd of June, looking for a minimum 70% probability on stocks that were an uptrend, no duplicates, Win, NVIDIA, Las Vegas, Sands, X with a 20/50 and 19.5 strike, 100% success rate. It looks like all of them pretty much reached full profit, so it was a 15.7% return. So in the market conditions, I think where we've seen with some stocks pulling back 1 or 2% and still, you know, the end of last week, stocks pulling back more, the tech ones starting on that Thursday and pulling back into Monday, even though there were techs here, I think that little extra coverage, 2-week time period, still getting reasonable net credits of 40 cents, 50 cents, and more, and having the downside protection in place of that fall resulted in a much better return over the past 2 weeks in the weekly covered calls. So without going, of course, back and going from 2006 and showing you everything, and maybe I'll have Ernie do this bull put weekly over the same time period, but remember, we found that going 2 weeks out, 11 days out with the trades here, I opened this on June 12th, would have opened all these, I would have had 100% success rate. I would have opened 15 positions probably in my portfolio. But again, this shows us that over the last 2 weeks, the bull put credit spreads greatly outpaced the covered calls. but from what I remember when Ernie did this testing over a close to or similar time frame of what we saw with the weekly covered calls, when factoring in losses that did occur because they're leveraged, we have to remember that, and different management techniques of using a 10% stop on a stock, which might have gotten you on a full loss on the spread, I think this return was around 45, 48%, so in that same range. But I'm going to have him rerun the test. I'm going to have him run this test over the same time period, starting on 5/15/2015, maybe to current, okay, maybe to June 23rd. I'll ask him to do that Monday on the bull put weeklies with some stops involved in this, and then I'll get back to everybody on how the weekly covered calls on that list over that almost 2-year period compared to, that's what we'll do, we'll do a 2-year period. How about that? From 5/15/2015 to 5/15/2017. Maybe we'll just go June 20th to June 23rd, 2017. And I'll have him run the weekly bull puts in the same way with some stops in there, and I'll let everyone know what the comparison is, okay? All right, so that's just some expectations. There is management involved, and as we mentioned to Martin, if you want to know when these positions were opened or how are they tested, whenever you open the monthly picks of the day or the weekly picks of the day, just click on that link over here to see how we develop these results, and you'll see how Ernie put his trading plan in. Okay? Bob, I see your question. Brandon says, my compliments to you for having the courage to do a live demo which showed real results. Hey, no problem. If I didn't use the back testing, then I wouldn't do that as well. Daniel says, what about vertical puts examples? Okay, well, we showed that. Okay, that vertical put spread, a bull put credit. You know, the searches, I think my popular search that I'm using now for my bull puts, I usually don't trade bull puts on stocks that often or bear calls, but I think we're in a bullish market. I've been much happier trading these weekly bull puts 14 days out in time. And again, for me personally, I don't like to open new positions on a Friday. Even though I'm going 2 weeks out in time, I'd probably look to see what these results were for the weekly bull puts on Monday, and then I do my other analysis to make sure, look at the stock chart, take a look at the company information, make sure there's no earnings, but I think that's already checked. And of course, the stock chart, company information, news, and profile, and to make sure it's a position that I feel comfortable is still bullish going forward. There are other defaults here. The initial value screen, looking for some similar stock criteria, but monthly options and the bull put number 1. But I've been content, very happy with these 2-week out ones. But again, in general, I'm not trading them as much on stocks. Typically, when I do a bull put or bear call, I'm doing it on a broad-based index or ETF, okay, because I don't want any surprises. Had a really successful 2-week period a couple weeks ago, maybe a month ago, and because I was trading short-term long straddles on stocks that had earnings, and it just so happened that there were Nordstrom, Macy's, they were all in a block, and I opened 2 or 3 of those. Macy's had it one day, and I had a long straddle open, and then Nordstrom was 2 days later, and then someone else, I can't remember who it was off the top of my head, I can look real quick. But in any case, when Macy's and the first 2 brick-and-mortar companies hit, it dragged everything else down. Before I even got to earnings, I had almost a 40% return on the straddles that I had opened for the other retail stores because it drags everything down. So that's the risk. And we saw that last week, 2 weeks ago, right? So 2 weeks ago, sure, Tesla and Baba, Sam's familiar with those. He's made a killing on Tesla, I believe, over the past several months. And BABA, he's a regular here at our Friday presentations. But remember when the techs and Apple just started to pull back, and it was not related so much to earnings, it was just the sector itself just started to drop. And I had a position on AEIS that was a married put that was around $79 per share. And it was up about 30% from where I got in at 56, almost 40%. But within a 5-day period, it's now down to 69. And it didn't have earnings. Okay, it hasn't had earnings yet. So that's just one of the risks of doing these leveraged spread trades with this as well. Now, Daniel, I'm going to get a little bit more in depth into your discussion because maybe you want to see what is a bull put spread and what is a good idea. Well, it all depends on your outlook for the stock. But first, we're going to change gears here. I'm going to get off of spreads. I promise you guys I'll try to get those results for you for the back testing, 2-year period. Let's just call it June 20th or so from 2015 to June 23rd today, 2017. I'll have Ernie run that bull put weekly search and the covered call screen with that starting portfolio amount of $100,000, and we'll see what the returns are with some basic as Ernie did it on his, but then I'll look at it with some basics on the management for bull puts as well, the entry time on Monday and the exit time if there was a drop in the stock price of maybe more than 5%, or if the stock was within 1% of the short put or 1% below the short put, close out the position. We'll see how that goes, okay? Bob's question, okay? There's one I'm going to actually answer with my analysis I did today, Bob. Bob's question is related to the married put position that we advocate here at RadioActiveTrading.com. I'm sorry, but we advocate RadioActiveTrading.com techniques. For many years, about the past 7 years or so, I've used this technique with about 50% of my trading capital allocated to options trading. Another point, Brandon, on your discussion about cover calls and bull puts, yeah, we can see that one is better than the other, and we also know that, well, in the last 2 weeks, we also know that bull puts are less capital intensive, so you can afford to open more trades in that situation, depending on your account size, of course. But at the same time, I feel that there is I've been more successful with a mix of positions in my portfolio. I prefer married puts and collars to represent 50% of my portfolio because I know I can't lose more than 4 or 5% even in a large market drawdown. All right, I've capped my losses on the position, which Bob's going to laugh at me when I show what I did today on my newest radioactive trade because I actually increased the risk, but for a reason. And I'll explain that. But at the same time, I did mention that I'm still doing, you know, a certain percentage, 10% of that allocated capital of my portfolio to options trading is in bull puts or bear calls on the broad-based index. It's a good premium. It's a good leverage return. It's a good use of money. But I don't want to do 100% of my portfolio into one strategy. Right? I like to mix it up a little bit. I've got about another 15 to 20% in calendar spreads and diagonal spreads. Okay? And then right now I'm playing 10% with this idea of short-term long straddles on stocks that have earnings coming up in the next 3 to 4 days as well. Okay? That's a little tougher because you have to stomach a 50-50 win-loss ratio at best in most cases. But in any case, Bob's question for the radioactive trade, the married puts, how would you recover when your married put trade doesn't work out? Well, there are different levels of not working out, Bob. Okay, and I'm going to, all right, I'm going to show something here as well. And of course, Daniel, I see your question. I'm going to get to that with a bull put spread. We'll do some spread comparisons in just a minute structurally. But I'm going to go to the portfolio. Some of you may have joined me for a webinar last week where we invited everyone, Blueprint owners, Fusion subscribers, and those who don't own the Blueprint and Fusion to come and see what was the idea behind bulletproofing and canceling the risk, and I opened a free trade for everyone, which I actually opened in my personal account. All the positions I show in my Fusion portfolio are my actual trades, okay? They're real trades. All right, so here is the position I opened. I'm going to go to the profit and loss chart to make it more easy. On June 9th? June 10th, 11th maybe, I'm sorry. Maybe it was the 12th. Oh, in any case. Yeah, but it was Tuesday, the 13th, I think. I opened Citizens Financial Group, 100 shares at $36.85. And at the same time, I bought the January 40 put for $4.89. Yes, this makes my investment $41.74 out of pocket, but the most I could lose on this position was $174 of what I invested, because I'm guaranteed to get 40 back no matter what happens. So I'm only risking 4.2% on the position. And the stock pays about a 1.6% dividend, I believe. So even if I held it all the way to January, this might only be a 3.2% maximum risk on the position. But you can see what happened. I got in up here thinking this was a bullish stock. I'll talk about that in just one moment. But I got in at about $36.85. The stock's now down 2 points, $2 and let's call it 35 cents or so from when I got in. So it's not quite 10% yet, but we can see the numbers there back on the portfolio very quickly. The stock is down 6.4% to 36, and I've gained $166 on my put. So right now I'm only in a loss of about $70 or 1.7% on the position. Okay? So there are multiple ways. Let me show you one more thing. Okay, and this is going to be sent to, I'm going to send an email to Fusion subscribers, Blueprint owners this weekend. Okay, but I'll show you guys a preview of that email. Anyway, let me go to big charts. I have customized big charts to show me the Bollinger Bands, the MACD, and the RSI. These are some of the indicators I use for entry and exits. We talked about that recently in one of our other presentations. Here's the MACD. What you typically want, of course, is the MACD line, the blue line, to be above the 9-day EMA, the red line, and you want them, if best, both to be above the divergence line. When we talk about crossovers, of course, oops, sorry folks, here we see a MACD crossover where it was middling about, and then the MACD crossed above the red line, and then they both moved up above the divergence. Well, okay, when it happened, it's a lagging indicator, of course, but when it happened, stock went from 35 up to 37. Decent move, not stellar, not out of the park, but a decent move, a good bullish trend. And then we have our other crossover. Here's where the MACD went below the signal line. This was related to earnings, so it would have been tough to catch that. But we see what happened after that, of course. It dropped down from 37 back down to 34. I'm sorry, went up to 38. That was, yeah, a little bit better move. A little bit under 34 to a little bit above 38, so more than 10% move after that first one. Now we have the negative crossover, and you see the stock eventually ends down to about 34.50. Why did I get into this trade on June 12th? Well, look at the chart from what I analyze things, and I explained this during the webinar. There's my crossover. It went back above the 20-day moving average, and we got in here. And the stock did go up a little bit more, but boy, did I pick the top. It came down a little, and then it went back up to about 37, and then it started to fall. And we see here that now we have, it was falling, but it hadn't dropped below the 20-day moving average. The other day it did, and then we have a negative crossover. Okay, why is this important? Well, other than analyzing stock, why is it important? Well, it's kind of important because here I am on this position. I just showed a chart where I saw a negative MACD crossover there, and it just dropped below the 20-day moving average, what I might use as a bearish indicator. So I was faced with some ideas today. Okay, now that I saw that crossover, it did go yesterday, it was confirmed today, although it was as low as 34.33 today, and it came back up a little bit. But in any case, what do I have here? I have an asset that's lost, what did I say, 235 or so? Okay, so down about 6% of what I invested, and I've got one that's up $1.66. Okay, so I have two working assets. I'm losing on the stock, but I'm gaining on the put. So when you're losing on one and gaining on the other, what can you do to evaluate a position? Well, there's two things we can do, of course. Number one is I could say, well, if this trend that I saw really makes me feel, I know that's a terrible MACD crossover, but let's see, here's our MACD line, and then we just saw the signal line just kind of cross over here, so we're at a negative crossover. What does that mean? I'm thinking the stock's going to go down. What's going to continue to gain money if the stock falls? My put. What's going to continue to lose money at a delta of 1 as the stock falls? My stock. So first option is I could sell to close the stock for a loss of 235 and leave the put open. Okay, but what do I have to factor into that? Well, if I close the stock right now, take that out, and left the put open, I've got to add 235 back in. So let's call that 490 to make it simple. My new put cost would be 720. So that's going to affect the break even of this position. We'll call it 725, I think. So now I'm holding this put at 725, but my break even's at 32.75. Well, that is at expiration. January expiration, I need the stock to be trading below that. But again, here I've taken the stock off the table, I took the loss on it, and now I can profit to the downside. What if I'm not 100% positive? Okay, and we never are, but this is a trend I follow. I'm honest with my subscribers. We hosted a webinar at the beginning of the year of what I'd use for technical indicators to manage the positions. So let me put my stock back in, 100 at 36.85. So I think the stock's going to, oh, tricky entry, Mike. Got to add the stock back in. There we go. Okay, so here's my position again, 4.2% risk. If I think the stock's going to continue to fall, rather than closing out of the stock because it might, hey, what if it gaps back up again and goes back to 37 or so, then I'm going to lose a lot on that put. I've set it from a bullish position to a straight bearish position. But what about both directions? Is there a way to profit in both directions? Yes, this is where one of the new income methods, income method number 12, comes in. I can add an extra put to this position, which will increase the cost. We'll have an upper and lower break even now, but at the same time, if the stock continues to fall, I could still realize a profit, but if it goes back up, I might still have a profit. There's multiple ways to do that. The way that I did it today is used a short-term put combined with a different income method number 6, which is one of our riskless spread trades. So I was able to generate 70 cents of net credit on this position, and then I used that 70-cent credit to purchase a short-term put at 145. Okay, so I added in a short-term put July 35 for 145 at the time I bought it, when the stock was at 34.33. Now this gives me a new structure, and the loss is still 5%. It went up a little bit, but that's not January. That's at July expiration. If I hold at July expiration, the stock happens to go right to 35, I'd be down 214. Sure, I increased it from 4.2 to 5%. Why would I have done that? Because if it continues down as I'm expecting at 32.19, I'm going to be at a profit, where I'd be at almost the full loss on my standard married put. Is the break even 40.02? Well, sure, at July expiration, but remember, when we hit July expiration, I'm either going to have closed this, managed it, or adjusted it, and I'm still holding the January. Why did I consider this a better idea than just closing the stock and holding the put if I think I'm seeing a downtrend? 3 reasons. 1, it gives me profit in either direction if the stock moves down or if it comes back up. Oh, sorry, let me go to stock research. Okay, so if this trend quickly reverses, I'm in a good position. What else do we know about it? I've got earnings coming up on July 21st, expiration day, before the market opens. So if this stock drops down to $32, it continues this downtrend that I'm in right now, okay, and keeps falling. Well, if the stock's trading at 32 before July 21st, I can sell that 40 put for probably $9.50, cutting down the cost basis, and then buy a cheaper 30 put at a credit. So now I have a 35-30 bracket, almost a strangle, on this position going into earnings where I can profit still in either direction with a lower risk. The third thing is, and I'm not going to cross it right now, of course, but why didn't I want to sell the stock and then buy back in later? Well, because I've set up the structure where I can profit in either direction. And remember, it does pay a dividend. It looks like the next dividend won't be till 8/1 or shortly after this, but that's why I'm still holding the January put and didn't want to shorten both. Okay? So there are multiple ways to do it, though. Other things I could have done is just not bought the extra put with a combination, the bear call spread, which I'm not showing, and I could have just moved this put down. Remember, we had a $1.66 gain on it, right? So I could have taken a $1.66 profit in, cutting down my original cost basis here. That wasn't 43.19, it was smaller than that. It's the 41.74. So I could lower my cost basis down below, right at about $40. But again, of course, I'd have the 35 put, so if I moved the put down to keep protection, I have the 35, so it might have increased my risk, but had a lower cost basis. What do we know? Why did I buy an option that was 8 months out in time? Because the time value decay is in my favor. It's not losing its time value. In fact, the price went up, of course, because the stock fell 235, so we gained 166 on this put. But the shorter term options are cheaper. What if I sold that at $6.55, and then still went through earnings and bought a July 35 at $1.50? I almost paid for this with the $1.66 I gained on this original put. But yes, I would have lowered my cost down by 5 points. So I would have increased the risk, but I would have had a much lower cost basis on the position. That's income method number 9 in your blueprint. You want to evaluate that if you think the stock's going to recover or you're going into earnings, rolling the put down to take on extra risk. That's great to do, only if you think the stock's going to recover. I'm in an unknown right now. I've been in this trade for 9 days. I opened it as a free position that everyone saw the original entry, and we emailed everyone when it was open. and let them solve the archive. But the adjustment that was done today was just shown to Fusion subscribers and Blueprint owners as well. I'm going to open 2 more positions. So long story short, as a Blueprint owner, what are the 4 things really you could do if the stock moves down? You can set yourself up with income method number 9, which will lower your cost base but increase the risk, and then you can decide if you think the stock's going to come back, is that the best one? We walk through the decision-making process in the Blueprint. You could cut the time and roll it in, but you'd still increase your risk on the position, okay? If I kept the 40, I'd have a lower risk, but then I'm still at a higher probability of it doing that, okay? I did a combination using income method number 12, planning to see that that downtrend is going to continue now that I've seen the MACD crossover, so I can try to profit in both directions. Didn't increase the risk by all that much, about 5% or so was just the straight put in, which does carry me through the next earnings in a month, okay? And then, of course, the third thing I showed, which in this case didn't match what we call the Siegel Model, which stands for all the income methods we talk about in the Blueprint, the 12 adjustments off the married put, and some other ones, the combinations that we use in the full chapter on combining income methods. What were the conditions? The stock did not follow the pattern I want when I opened it. I now saw a MACD crossover, and I think the stock's going to be short-term bearish and drop a few more points based on the weakness and the crossover. My expectations? Well, it's going to continue down, but it could snap right back up. I have to appreciate that, and I have to accept that. So rather than that first example I showed you, where if you feel confident, Bob, that it's going to go down, you can sell the stock and leave the put, but now remember, you're going to increase your break even because the cost of your put is equal to what you paid for the put plus the loss you took on the stock as well. Okay? So I wanted something that instead of was just one way or the other, I made a trade that gives me both in the short term to July through the earnings that's coming out where I can profit in either direction, and at the same time I still have that put out to January. I didn't shorten it, I still left it open. One of the other advantages of doing that if I stay in this longer again is it pays a dividend. Now we're not crossing the ex-dividend date before the earnings, okay? My sentiment might change after the earnings come out, but like I said, I might still be at a profit in either direction. But that's why I didn't sell to close the stock either, to turn it in just a bearish position, because I missed out on the dividend. Now sure, if the stock fell to 28 and I'm just holding the 40 put for $7, I probably wouldn't care too much at that point. I'd be profitable on the trade. But again, I entered this as a safe stock that pays a slight dividend. It reversed on me, so I'm reversing with it. That's what's in the Blueprint, is those Siegel Model, is the decision-making process of when to use what income method and why. And I can't go through all of it right now. Obviously, I can't teach you 250 pages in the 10 minutes we allocate to each question. So, but that's it, Bob. That's what you do. You go with the flow, okay? What are the most important thing, or what are your expectations of the stock? Set up your trade to be based on that. And again, if you feel that the stock's dropped, it's not going the way you want, as you mentioned, how can you fix it? You think it's going to continue to drop? Set yourself up in a position that has a bearish risk-reward profile. You've got 2 working assets in your favor. Okay, work with them. All right, and there's ways that you can set it up to even lower your risk and be able to profit in both directions potentially as well. Okay, so back to Daniel. Daniel was asking about spreads, and he said, can you give an example of a bull put spread? And I think I misunderstood your question, Daniel, and I apologize. What I was saying is that here in the search we have sample criteria for you to use as a stepping stone. But what's better? Okay, let's take this Tesla bull put spread for right now, okay? And we're just going to take a look at the profit and loss chart with some ideas here. Actually, I'm going to go to this what's called our search by symbol tool, Daniel. So here's Tesla at 383.45. July 7th, 14-day out trade. We're shown selling the July 365 put at 445. Buying the 357.5 puts, this is a 7.5 point spread, for $1.15. We have at a 72.6% theoretical probability the stock's going to be trading above 365 in the next 14 days. And this is an 18% return. Okay, so what I want to do here, I'm actually going to go what's called the midpoint spread chain. Okay, so what our midpoint spread chain does, it's going to show me potential bull put spreads that match this criteria. I'm going to take the spread width out, Minimum net credit we just said was $1, so let's put a minimum net credit of 50 cents, probability of greater than 70, minimum return 5. Oh, there we go. Let me submit that. Okay. So now I have different spread ranges, mostly 5 as a default. But the spread we were originally looking at, was the 365 position. Okay, so we saw what the return was with the 365, 357.5, a 7.5 point spread. We were looking at an 18% return with a 72.6% probability? Yeah, 72.6% probability of net credit of $1.15. So here's a 5-point bull put spread, where at midpoint, I could get $1.18 on a 5-point spread. That's assuming midpoint, of course. And the return is 30.7%. And the probability, by the way, is exactly the same. Okay, let me put this here. This is our bull puts on the right-hand side. It's 72.6%. It would stay above it. So I'm selling the 365 and buying the 360. And at midpoint prices, this looks really good because we're getting $1.18 net credit. Now, midpoint, I know, on the other one, our 7.5 point spread would probably be, midpoint would pay closer to $1.38. But this is a almost 31% return for a 14-day trade. Stocks at 383, we're selling 365. But maybe you want a little bit more protection, okay? Maybe you want a little bit more insurance. So naturally, what do? You go for the higher probability. Okay, so we could go to an 80% probability here. And I'd have a 357, so I'm actually 7.5 points lower, 357.5 sell put and a 352.5 buy put. So it's still a 5-point spread. We're getting a lower net credit naturally because we're further out of the money, but it's still a 21% yield. And you could go to an 85% probability with a 54-cent net credit and a 12% yield. Okay, so when you said what is examples of a bull put spread, here's examples on Tesla. Which is the best one? I don't know. That depends on your risk-reward tolerance. The most conservative is down here with the 85% probability still offering that 5% return and that minimum 50-cent net credit. That would be the most conservative, furthest out of the money. The most aggressive and likely not profitable, let me phrase that. The highest potential profit is naturally going to be at the position with the lower probability and the still higher net credit on the 5-point comparisons. But are you more comfortable with spreads that are in the 72, 75, or 80% range? Personally, I'm usually about here, 78 to 83% on my spreads. Okay, it's usually I look for about 77.5 or higher, but usually I don't go to 85 or 90 because then I'm not getting the net credit I want on most cases. And it's harder to do that on SPX and SPY because they're not as volatile as Tesla. But you've got to be bullish on this. You've got to think that this is your point. The selling put is your point. You're literally looking at the chart and saying, even though PowerOptions Tools has shown me all the calculations with an 82.7% probability of it staying above 355, I'm getting a 64-cent net credit and a 14.7% return on investment. If you look at that chart and say, no, Tesla's been showing weakness, as have all the techs, although it's maybe recovered a little bit, and 355, sure, it's 20 points almost below where the stock is at 383.45. But if you don't feel comfortable with that strike, you don't feel real comfortable in the next 14 days or so, the stock's going to be above 355 for whatever reason, market weakness, your fear of unexpected events in the future, next 14 days, geopolitical events, or anything along those lines, the condition of the market as a whole, then maybe you don't want to do this trade. Maybe you want to look for another spread with a good probability. But you said for your examples of the bull puts, what were the examples? Well, this is a good comparison here. It's showing you, are these all good trades? Yeah. Which one's better? It depends on what your gauge of better is. If I grab 50 people from the floor of the CBOE, 50 investors or pitmen, pitmen or pitwomen on the CBOE floor, and I showed them this table and said, show me what is the best bull put spread, I'd probably have an even distribution for all 6 trades. All right, so about 8 investors each would say this is the best spread, this is the best spread, this is the best spread, this is the best. They'd all probably be about even, because depending on if you're more aggressive and looking for that higher return and higher net credit, or if you're more conservative because you want the higher probability but you're still getting a double-digit return for 14 days, they're good trades. I don't, again, have the numbers tell you which one would be more profitable. Okay, and Daniel says, what about bull in and out spreads? Buying an in-the-money call and selling an out-of-the-money call. Better risk-reward profile where you might only be risking 1-to-1. Okay, have a 1-to-1 risk-reward ratio instead of here. What do I mean by that? Let's take a look at this very quickly. My apologies. Okay, so here is the conservative spread, 85% probability, 54-cent net credit, which means we'd be risking 446 on the position. So we have a 54 to 446. Let's make it nice and simple. Let's make it 50 cents to a risk of 450. Okay, that is a 9-to-1 risk-reward ratio. I get a lot of questions, and I think we even covered this a little bit last week, but I get a lot of questions of how can I reduce this risk-reward ratio? My answer is easy. You go closer to at the money for a lower probability. So here, 5-point spread, let's say we're making $1.20 on our 365, 360 for a risk now of 380, right? So the 5-point spread, the most we could lose is 380. Now we're at a 3-to-1 risk-reward ratio. But there's only a 73% chance of that. Okay, well, are we comparing apples to oranges here? It's hard to say. You know, is this probability really worth it to get a 3-to-1 versus a 9-to-1? And then what about doing a bull call debit spread? See, here's something we're showing you, Daniel. What we have here is the put credit and call debit parity. In this case here, which is interesting, that deeper out of the money one, which would be deeper in the money with the calls. Now, if I sold the 352.5 call and the 347.5 call, I'd have a debit of 445 to get 55 cents max profit if everything stays above. So I'm a slightly higher return. But that's not, actually, yeah, it's the case for the in-the-money ones, because this is the midpoint spread chain. What do we know about in-the-money calls versus in-the-money puts? The bid-ask spread gets wider. So I'm not guaranteeing that you're going to get the midpoint, but if you did, the in-the-money bull call debits are showing, well, in most of the cases, are showing a higher percentage return than the bull puts. So here and here, the bull call debit parity trade, same risk-reward profile, is offering a higher return. Here it is as well, 25% versus 23.8, and then it's not. So these would be bull puts if you chose those strike prices and those probabilities, okay? So what about out of the money in either direction? Well, it's a little bit risky. So percent out of the money range, let me go less than -2 to 0, -4 to 0. Let me try that, okay? I was hoping that would work, but it didn't. Maybe I have to reverse it. I don't think it likes the negative. Oh, there we go. No, that didn't do what I wanted it to. I should try the other way. Oh, thank you. Helps if you take out the probability, doesn't it, guys? There we go. Okay. So now what about an in-the-money? Okay, sorry about that. Going through the question. Oh, Daniel said, what about an in and out spreads buying the in-the-money call and selling the out of the money? Okay, so we're at 383. I didn't go far enough. I went too far. Let me try, I'm sorry, let me try -3 to 0, okay? Let me see if I get that right. Now, I want to get it, I'm just going to use the, this one's close enough, but not quite. I want to get lower than that. Okay. So anyway, let's go to the custom spread tool. We saw some of the other spreads, but let's say with Tesla right now, we'll go 2 weeks out to July 7th again. My apologies. There we go. and I want to buy an in-the-money call. I'm going to go 380. Let's go 380 to 390, okay? So 1295, 1340, okay, we'll just use the natural prices here. So here's a much better profile here. In this case, you're looking at a debit spread comparison. And my debit, and I did a 10-point spread this time, okay? But the debit here would be 495. So the max profit is 505, so I have greater than the 1-to-1 risk-reward ratio. But you've got to be bullish. You've got to be aggressively bullish, because in order to get that return, you need the stock to be trading above 390. You're looking at about a 34, 33% probability of making this 505. Your break-even's 384.95. Okay, so you need the stock to move up a little bit before you hit break-even in 14 days. Not too bad, but you've got a 1-to-1 risk-reward ratio. You're going to have to be right more than 50% of the time. You're going to have to pick stocks that are going to move. You know, this is about 2 or 3%, I guess. Less than that. I'm sorry, less than that. But you need it to move up, and you've got to be bullish on it for that to work. So again, is this a much better risk-reward profile? Remember, we saw 9-to-1 risk-reward profile with an 85% probability and a 12% return. Okay. Then we looked at the 30.9% return, or let's just call it 31% return, with the, reversed them, I'm sorry, with the 72% probability with a 3-to-1. And here we're essentially looking at a 1-to-1 risk-reward ratio with a 102% return, but only a 30%, 33% probability of the stock being above 390 and making that return. Okay? So what's better? I can't answer that without further testing. Why? Sure, you're risking less here in the cost, but of course, you know, we're risking less in the 5-point spreads. I use a 10-point spread to get the 1-to-1 ratio. But you're going to be risking less with a lower probability of making more, but the potential to make more. You still got to be right more than 50% of the time. Here you're right. I've got to be right 90% of the time to profit long term. Here I'm probably 31% return, 72% probability. Probably actually going to have to be right closer to about 74, 75% of the time in order to profit long term. Here I have to be right 50%. But you're taking that chance that the stock's going to climb and be above both to get that more than 1-to-1 risk-reward ratio, or the 1-to-1 risk-reward ratio as well. I can't answer which one's better, Daniel, because more than anything, I can run back tests on these for you at some point or another. But the key is that what this comes down to is, what is your preference? What is your trading plan, and what is your risk tolerance? Are you conservative and want an 85% probability of success? You got to take a 9-to-1 risk-reward ratio. That's the nature of the market. Are you okay taking a 65, 70% probability, looking for a 28 to maybe 35% return? Okay. You're in this range, a 3-to-1 risk-reward ratio. Are you aggressive to where you realize you're okay losing 50% of the time or more, but the spreads you open are only going to have a 1-to-1 risk-reward ratio, and you're okay losing 50% of the time and even sometimes taking the maximum loss versus sometimes winning slightly or sometimes taking the maximum profit? Okay. Then in this case, if you're bullish on the market, you're more bullish, you expect more movement in the sector or industry that you're trading, then here's your 33% probability, more aggressive spread. I'm here. I already told you that. I'm closer to this range. I'm really about 77.5 to about 84%. That's usually where my spreads range. That's me. Okay? And in the right market, you would make a killing here. You know, I'd say probably, let's say that we did these kind of in and out spreads, as you're calling them, out of the money bull call spreads, as you're calling them. You know, just another name for it. That's fine. But I bet you if you did that from January to, well, without that first little dip there that we had, but let's say from mid-February to April, you probably would have made a killing. You'd see very high percentage gains on your portfolio. There would have been 1 or 2 hiccups, but you probably would have looked very good. But is that the same thing that's going to work long term? Okay, is what worked 6 months ago going to work 6 months in the future? I don't know. Okay, all right, and to further that along here, Brandon's follow-up to that is, what you haven't addressed is the remote probability of being assigned on the option having to buy the stock for 38K. Is this a risk in your mind? Yeah. I'm sorry, Brandon. Yeah, it is. I'm sorry I didn't address that before. Let me go back to the spread chain. Oh, it opened in a new window. I'm sorry, folks. But yeah, back on that midpoint spread chain for Tesla, this is always a concern when you're comparing, and we did it a little bit last week too. Sorry. But one of the concerns with the bull put credit is getting assigned early. But remember something, Brandon. Let me go back, actually. I'm sorry, Brandon. Let me go back. Now, in this example that we're looking at on my bull call debit, remember, so I bought the 380 and I sold the 390. If the stock jumped up to 410 on Monday and I got assigned early, great. I've made full profit 13 days early. Fantastic, okay? But remember that what Brandon's saying is that if you did the opposite, if I sold the in-the-money put, which I'm talking about a debit spread, a bull call debit, where my call is actually out of the money right now. But let's say we did the bull put where I sold the 390 and bought the 380. Aren't you worried about early assignment on the put because it's in the money? Absolutely. I'm sorry, we did cover that last week. That's why I don't do an in-the-money credit spread where the short option is in the money. Okay. I've seen investors do these out-of-the-money bull call debits. So it's a call now where I'm selling the 390 call that's out of the money, really projecting on stock growth to get the maximum return at 100%. I would never do this with a bull put spread. I mean, I do thank you for bringing that up. I would never do this on a bull put spread where the put's in the money. Well, you say big deal. So if you get assigned at 390, you just exit at 380. You know, force someone to buy your shares here so you don't lose the 10 points. Well, stock's at 383. I'm going to sell those shares at market at 383 and not take the full loss, okay? But I'm not getting, now that it goes back up, unless I stayed in the stock, yeah, I wouldn't have picked this, and I wouldn't never have done an in-the-money bull put spread. I'm with you on that. I agree with you 100%, because I don't want to do an in-the-money put. Or reverse, if I did a bear call, I wouldn't want to sell the 375 and buy the 385, because this is an in-the-money call that can get assigned, okay? So I'm automatically at the loss. I'm short stock now. But the one thing that I do want to remind everyone we covered last week is that whether you do a bull put credit spread, here's my sold put, and then we buy the lower strike put, or you do the bull call spread, the debit spread, where you buy the 380. Remember, if you don't close the position before expiration and the stock's trading right here, and you forgot to close the position or you didn't roll out of it, remember, if this is July 7th, I'm sorry, and our Tesla is at 383, if you did this bull put, you'd end up owning shares of stock on Monday at $39,000 for, as you mentioned, one contract, right? That'd be 39K. That's why I wouldn't do it. But if you did the bull call debit spread, you would also be long shares of stock if you didn't close it before expiration. Now, you control the long call. You'd have to close it before expiration, because if you leave it open, well, your broker's not going to sell to close it for you for the 345. They're going to go ahead and buy shares of stock. They're going to assume you wanted to buy shares of stock at 380. So the outcome of a bull put credit or a bull call debit where the stock is between the strike prices, if you don't close it, is that you're going to end up being long stock. On the bull put, you'd be forced to buy shares of stock at 390. On the bull call, if you didn't close it, your broker would assume you wanted to buy shares of stock at 380. Either way, on Monday, you'd be long shares of stock, and the risk reward would be about the same on that as well. Okay, so yeah, I don't do in the money bull puts, and I don't do in the money bear call credit spreads. But these ones here, the out of the money bull call debit, I see investors do that. I have what do I want to say? I'm sorry, I have some financial advisors and brokers that use PowerOptions from different services, Merrill and Ameriprise, blah, blah, blah. Some will do this, okay, this out-of-the-money in-and-out bull call spread, as it was called by Daniel, but they'll do it out to October or November. Why? Because it's easy to place, shows a high percentage leverage return, and they really don't have to watch it for 4 to 5 months. Okay, and they're really hoping that if it does go above that by expiration, great. Done. But they're giving themselves more time rather than doing a 1 week out or 2 week out in and out spread, as it's called as well. Okay, some commentary from Sam here. Back to when I was talking about the the tech stocks. I'm sorry. He says Netflix was this week, 30 calls at the 150, stocks at 148, and the option premium is about $3. Took a big trade because of the candlestick pattern that was there, and that. And anyway, I'm sorry, the real comment Sam was making is the Tesla bull put. Now that we're analyzing, I'm not making a trade recommendation or suggestion. I just sort of mentioned why I might consider doing it this way for that better one-to-one ratio only on a debit. I would never do it on a credit because of that risk of getting assigned early on the position. Okay, but yeah, Sam was saying his Tesla bull put got $20 lower in 1 week. That's what we were talking about with the tech industries falling. You know, you saw Tesla fall 25 points, Apple fell a bit. My AES position in that semiconductor sector dropped from about 78 to 70. It dropped about 8 points. It doesn't seem like a lot, but it's over 10%, and it happened in a 3.5-day period. So again, that's what you can kind of expect there on those also. All right. So, Brandon, I'm not saying that, I'm sorry, Daniel, I'm not saying that that's a bad idea to do that out of the money spread we were looking at, but again, it's preference. What is your risk tolerance versus your trading goals? Okay, that sort of helps you structure. Is it better to get closer to that one-to-one risk-reward ratio and only have a 33% probability of success? Is it better to take a 70% probability and have a 4-to-1 or maybe 5-to-1, or is it better to go up to 85% probability where you're taking the 9-to-1 risk-reward ratio? That depends on the individual investor. And we could run back tests all the time, but then it also comes down to what stocks do you pick, how long is your time horizon, and so on and so forth. And again, I mentioned that if you want to do that in and out spread, as you called it, I would suggest doing it just on neutral bullish stocks, stocks that don't have a lot of volatility, that don't swing wildly. The real risk that you run if you do one of these in and out spreads where your call that you're buying, only on debit spreads, mind you, the call that you're buying is in the money, the call that you're selling is out of the money, and if you do it, as I mentioned with some of those advisors, do it long term, well, if you have a bad earnings in that first earnings cycle and the stock drops down 10%, well, you're at maximum loss. You now need the stock to gain 20% so you can get the maximum profit, and probably need to go up 15% so you can get to a break even. So that's a tricky one when you do debit spreads that are farther out in time, because you probably have to cross an earnings. Again, not the most advisable position to be in any kind of vertical spread, whether it's an out-of-the-money bull put, an in-and-out bull call, or more. Okay, testing is required. And again, perfect point that was brought up by Brandon. Or is it Daniel? I'm sorry, I'm getting you too confused. The questions got erased, so I don't see them anymore. But that is a very good point that I actually didn't address, and I would never do. That in and out spread we were looking at, I would never do it as a credit, where the option I'm selling in a bull put is in the money, or the option I'm selling in the bear call is in the money. It's too much risk of early assignment. And now you're stuck. Okay, you've got to decide, do I want to be short stock with the long call in case it reverses because you've changed the whole direction of the position? Or if you're forced to buy stock on the bull put and you've got that lower strike put, you're now in a married put, sure, but the whole reason you were trading spreads was to have margin to enter more trades and not be in the stock. Now you're in the stock. But do just remember that in any vertical spread, any bull vertical spread, bull put credit, bull call debit, if you leave it open to expiration and the stock is between your strike prices, you'll end up owning stock if you don't close it out, right? You'll get put on the short put. We all know that. But remember, on a bull call debit, it's the same thing. Your broker's not going to say, oh, well, let me go ahead and sell you the 365 call because the stock's at 383 and we'll just deposit that $17 in your account. No, they're going to assume you wanted to buy shares of stock. That's why you left it open. So you'll be long 100, 500, or 1,000 shares of stock at 365, depending on how many contracts you sold. And reverse, in your bearish spreads, if you do a bear call credit or a bear put debit, where you're selling the call here or selling the put that would be in the money originally and buying the higher, if it's between the strike prices, in the bear call credit spread, I'll be short shares of stock come Monday morning. because this short call is an obligation to deliver shares of stock I don't own at that price. And if it moved above it and I forgot to close it or just didn't close it in time, now I'm short shares of stock come Monday. And the bear put debit, where I bought the higher strike put and the stock's between the strike, well, good, your short put expires worthless, but your broker's going to assume that you wanted to force someone to buy shares of stock for you at that put strike price. You'll now be short shares of stock because you didn't own them. And if you did own them and you did the bear put debit, well, guess what? And that's just sort of a married put with an extra short put there in that scenario. So it would have worked out well. And it would have been covered. You just would have sold your stock at that put strike price and kept the premium. But those are the outcomes. When you do a vertical bear spread, if it's between the strike price and you don't close it, you'll be short shares of stock. If you do the bull call debit, bull put credit, and it's between the strike prices at expiration, you'll end up being long shares of stock on Monday. Okay? Either or. All right. Well, ladies and gentlemen, we're about 5:47 p.m. Eastern Time by my watch, and it's really not a watch, as you know, of course. It's the whatever's at the bottom of the screen here from the computer, because we use computers all the time. So there's always a clock in front of us one way or the other on our smartphones. If you have any last-minute questions, go ahead and send those in. I just want to remind everyone, if you haven't had a chance to test out the PowerOptions suite of tools, you can do so at any time. Just go to PowerOp.com. You'll be prompted to put in your first name, last name, and email address, and click Start My Trial. We'll send you a password. You'll have full use of the site for 14 days. After that, our subscription level service starts at $40 per month. That's for our end-of-day service, where the data is only updated at the end of the day. We do offer the delayed service, and those picks of the day I mentioned for covered calls and naked puts are only available on the delayed service or higher. It's not available on the $40 per month end-of-day service. But the delayed service has that available, and the quotes you get are 20-minute delayed. And of course, you can upgrade at any time from the 20-minute delayed service to the historical, which will give you full access to that backtesting tools we showed in the beginning, and you also have full access to historical option chains going back to April 2006. Of course, we do offer a real-time service, so anytime you run a search, refresh your portfolio, look at an option chain, you're getting the numbers and calculations at that very instant, and then you can choose to upgrade if you want real-time and the historical. That would be our premium level of service. But the subscriptions do start at $40 per month, and then, of course, you can upgrade at any time. Other free stuff, maybe you're interested in some other education, remember you can go to our blog at any time, blog.powerop.com. Some of those other webinars we mentioned on spread trading, management of spread trades, the archive of our other requested topics, open forum discussions, you can check those out anytime at poweropt.com/webinars.asp. That is a public page. And you don't need to be logged in to access. And of course, we do have a YouTube channel. You can just go to YouTube and look up Power Options. You'll see some of our archive videos as well. All right. Well, Martin says thank you. Have a good weekend. You too, Martin. Thank you very much. Sam, I hope you have a great weekend also. And Brandon, and of course, Daniel as well. I hope you gentlemen have a fantastic weekend also, and everyone else that's on with us as well. Troy and Wesley, I hope you guys all have a fantastic weekend. And Samantha, Jim and James, another John, a John and a Jonathan, of course. You guys, everyone take care and have a fantastic weekend. If you do think of a question later on, remember, you can send me an email at any time to support@powerop.com or support@radioactivetrading.com. You can also reach us at during market hours, on the phone at 302-992-7971. And remember, the trial members and subscribers can schedule a coaching session at any time.